All right, I want to start. I feel mean to do this. I'm throwing you under the bus a little.
Oh
Just
God,
a
I
little.
can't wait for this. Can't wait for this.
It's a friendly toss. You're still going to get hit by a bus, but
I think you still need a mustache to do this, where you twirl the mustache while you're doing
it's sort
this.
of like, haha, isn't it funny? I'm about to throw you in front of a bus. We were talking about a mutual fund, a strategy that's wrapped in a mutual fund the other day, and you sent me a screenshot and you said, looks like the fund hasn't done so well.
Yeah.
Now you made the, I don't think this was an error you meant to make, but what you did is you Googled the fund ticker and then screenshotted what Google plotted for the return. It posts the NAV. And one of the things you might not have been aware of, I will give you the benefit of the doubt, is Google does not give you the total return. It gives you the price return of a fund.
Yeah.
If you are plotting the price return, you can be missing a meaningful part of the actual return of a strategy. So we were talking about a future strategy, which tend to have really big tax distributions at the end of the year, because all that commodity trading normally gets wrapped in a Cayman wrapper that bubbles up as income. Everything else gets 60-40 tax treatment, realized, because you're rolling it. So you get tons of realized cap gains and income that gets distributed at the end of every year, and looks like, you know, this big drop in price. And so you can have these strategies that are consistently posting positive returns that, if you just look at the price return, looks flat, if not negative. And this is something that I'm not sure a lot of people are necessarily aware of. Like, I see this happen a lot. People post charts and they don't realize they're posting a price return and not a total return. And I think this is something that I take for granted as being like very obvious, but I want to spend a moment to talk about it, because I do think it's really important that when people are doing analysis, they both on asset classes or individual securities or strategies, they are actually looking at the right thing.
No, you're 100% correct. I am clearly an idiot, but also I was just doing something quick on Google and just to send to you, but also because in my world, nothing we do can be Google. You can't Google anybody's track record in my world, and everything we do in my world is total return in futures and options. So that's what I'm accustomed to. And right, I just screenshot like a mutual fund. I totally forgot about mutual fund distributions, K1s, all that stuff. And you know, like that's, but like to your point, how many people make that mistake? Like you said, sometimes when people are looking at any form of S&P index and you see those drops, they're not taking account the dividends, right, and the yield on that one and being taken out. So yeah, go on your tirade and bring that up.
Yeah, well, so I think a really easy example here where none of us will get in trouble is if you go to Google and you type in HYG ETF. So HYG being the ticker and then ETF. And what will come up is Google will plot the iShares, iBox, high yield corporate bond ETF price over time. And if you hit on the chart max, it'll go back to 2008-ish. And it'll look like this ETF started at a price of about 105 and is now trading at a price of about 75, which would make you think this was a losing strategy. The problem here is what Google is plotting is the price return, the price of the ETF every day, the NAV, like what should be in theory tied to the NAV, not the total return. So I'm using this as a particular example because I think it really highlights the problem. Within this ETF are high yield bonds. If I buy a high yield bond, or really any bond, what is my return going to come from? It's coming from the coupons, right? In the short term, you might get some price change in the bond from changes in credit spreads and changes in and defaults and changes in interest rates. But if I'm holding all these bonds from their sort of addition to the index to their maturity, then the total return is either it defaulted and I got some recovery, or I got the coupon over time. Everything else is sort of just noise. And so if you're only looking at the price return, if you're not taking into account all the income that was generated over time, all you're left with is the defaults, right? Some noise and what happens with in the short term with interest rates and credit spreads. But over the long run, it's just defaults. And so you would actually expect the price return series of an ETF like this to go down over time. The total return hopefully is going up, right? That income you're generating is more than compensating you for the defaults that are happening. But if you're only looking at the price returns of something like a bond ETF, you're going to lose money. Now, You would think this is obvious to most financial professionals. I will say I was once on a trip in Canada. I have an index that I manage that's tied to an ETF product there that is an income-focused product. An advisor pulled up the ETF ticker on their, I think they use Thomson machines up there, not Bloomberg, Thomson machine, which defaulted to price return, then proceeded to tell me that unless I did something to make the price go up, they would never buy the product. To which I pointed out that's not possible unless you want me to actively trade these things. If I'm just generating the income, all the return comes from the income. You got to look at the total return. Needless to say, I did not get an allocation from that advisor. But I think it's really critically important here that people understand when you're looking at an asset class or a strategy, you should be looking at the total return.
Yeah, like Dennis David said in the comments, in hedge fund land, it's like SPTR versus SPX, and that's what I'm saying. Like we use SPTR, S&P total return, so like that's what I'm used to. But like, why do you think if ETF or mutual fund or index, whatever, if it has dividends, distribution, yield, or K1 income, why isn't the default total return? Why is the default price return?
Well, I think the default is price return because plotting the total return requires back adjusting the price, right? So when you plot the price return, you're basically saying what was the price on that day? What was the actual ETF trading? So you can just get the data feed from the market and say, okay, this is what the price was. And you can just plot those prices over time. That is not wrong. But what it's ignoring is the fact that you had this income that was paid. Well, how do you account for that in the return series? I think an example would be, let's say there was a company that did a spinoff of 50% of their business, right? So you own Acme company and they do a spinoff of 50% of their business as XYZ. And so you get all of a sudden the shares of Acme drop by 50%, but you get these other shares XYZ. Well, if you plot the price return, Acme company looks like the price dropped 50%. But did it really drop 50%? Like, is that the right way to think about it? If you're trend following that stock or you're a momentum investor, like, did the company really lose 50% of its value? Well, yes, but that doesn't mean it lost 50% of its value because like there was this negative shock. Shareholders actually still have the same equivalent value. So what you need to do is you need to go back to all the historical prices and basically back adjust them in a ratio manner. So in that case, you would basically divide all the historical prices prior to that by 2 so that you can appropriately track the price going forward, which means when you look at a total return index, like the price of the total return index at any given time doesn't actually reflect the price it traded at. But it reflects the total returns an investor generated. But I've had these fights with people who do technical analysis. They often look at price return charts, and I say you can't look at a price return chart. First of all, I'm not going to debate whether you can or cannot do technical analysis. Limited point here. The limited point being you can't look at price return charts. You have to look at total return charts, because again, you can have these examples where if you were to look at high yield bonds, for example, and look at the price returns, you would never buy high yield bonds. Right? You obviously care about the income. If you have a company that suddenly pays out a massive cash distribution, it's going to look like a big sell from a momentum perspective. Well, that's not a sell necessarily. It's just that they took cash off the balance sheet, and of course the share price has to adjust down. Doesn't mean the future earnings are impaired or the growth potential is impaired. Right? The total return can still be the outlook can be positive. So you really need to adjust for these things. By the way, if you go like to Yahoo Finance and go to their historical data on everything, like they have an adjusted close they make available to you. So it's all there. Morningstar, all the funds are done in total return. It's just if you Google something, they're showing you price returns.